When you look at a company's financial statement, there's one section that really tells you where they're placing their biggest bets for the future. It's the cash flow from investing activities. And yeah, it can look a little confusing. But today, we're going to make it crystal clear. So, what does investing activities actually mean? I know, it sounds super intimidating, kind of like a secret code just for accountants. But I promise, by the end of this, you'll see it's really just telling a story about a company's biggest, most important decisions. To really get this, let's start with the official by-the-book definition, and then, we'll translate it into plain English. And there it is, straight from the accounting rulebook: acquisition and disposal of long-term assets. A little dry, right? But the key phrase here, the thing to really lock onto, is long-term assets. So let's figure out what that actually means. See, that's really all it is. Think of it this way. This whole section is just tracking the money a company uses to buy major stuff it plans to use for a long time. We're talking buildings, heavy machinery, and of course, the money it gets back when it sells those same things. So what exactly counts as a long-term asset? Well, it's the physical stuff you'd probably expect, like property, plant, and equipment. But it also includes stuff you can't touch, what accountants call intangible assets. Things like patents or a brand's reputation. It even covers long-term investments the company makes in other businesses. Okay, now that we know what these assets are, let's look at how they actually affect a company's cash. We're going to split this into two parts. First up, the good part. All the ways investing activities can bring cash into the company. To keep this super simple, just imagine a big bucket labeled cash in. Every single activity we're about to talk about is like pouring more cash right into that bucket. It's all about what the company gains. So how does a company fill this bucket? Well, mostly by selling things. When a company sells, say, a factory or a big piece of equipment, that cash is an investing inflow. The same thing happens if they sell a patent or some shares they own in another company. And hey, don't forget the income from those investments. Dividends, interest, and rent all pour cash right into this bucket. But of course, it's not all about gaining cash. You gotta spend money to make money, right? To grow, a company has to spend. So now let's look at the other side of the coin, the cash outflows. And here it is, the cash out bucket. This represents all the money flowing out of the company to buy those big long-term assets we were talking about. This is literally where the company is placing its bets on the future. And you'll notice this is a perfect mirror image of the inflow slide. Instead of selling assets, the company is buying them, paying for a new building, purchasing a patent from a competitor, or buying up shares in another company. All of these activities are emptying cash from that cash out bucket. And there you have it, the entire concept in one simple view. On the left, cash comes in when you sell assets or get investment income. On the right, cash goes out to buy new ones. It's this constant cycle of reinvesting back into the business. So we've got cash coming in and cash going out. The next logical question is, what's the net effect? Let's look at how we put it all together to get that one final number you actually see on the statement. And honestly, it's just simple arithmetic broken down into 3 super easy steps. First, you add up all the cash that came in from those investing activities. Second, you add up all the cash that went out. And finally, you just subtract the total outflows from the total inflows. That's it. Now, this is the crucial part. What does that final number actually mean? If it's positive, it means the company brought in more cash than it spent on investing. The official term you'll see is cash flow from investing activities. But if the number is negative, the company spent more than it brought in, and we call that cash used in investing activities. Now, a negative number isn't always a bad thing. Think about a young, growing tech company. You'd expect a huge negative number because they're buying servers, building out offices, they're investing in growth. A positive number, well, that could mean a company is selling off assets to refocus, or maybe it's just raising cash for other reasons. The number just tells you what happened. The why? Well, that's the interesting part. Okay, you have the core concepts down solid. Now let's just cover a couple important little details that will help you read a real financial statement like a pro. First up is a handy little mnemonic, the IDR rule. Interest, dividends, and rent received are always treated as a cash inflow from investing. It's a simple, straightforward rule that helps you classify these common items correctly every single time. Now for a truly fascinating, kind of weird accounting quirk. It all starts with this fact. Unlike buildings or machines, land is considered to have an infinite useful life. so its value is never, ever depreciated on the books. So, what does that mean in the real world? It leads to a very strange outcome. If a company reduces the value of land on its books for any reason, accountants have to treat that reduction as if it were a sale. This means a decrease in the land's value can actually show up as a cash inflow from investing. It's a weird rule for sure, but a really important one to know. So let's just do a quick recap. Investing activities are simply about buying and selling long-term assets. The easiest way to think about it is with those two buckets. Cash in comes from selling assets or from investment income, and cash out goes toward buying new assets. And that final number on the statement, that's simply the net result of everything flowing in and out. It's the bottom line of their big picture investment strategy. So now you can look at that line on a cash flow statement and know exactly what it represents, the story of a company's biggest strategic bets. But this, of course, leads to the real question. It's one thing to see where the money is going, but how can you tell if a company is investing wisely? That is the art of analysis, and now you know exactly where to start looking.